Good morning, everyone. My name is Sabrina Kofer, and on behalf of Choice and ACRL, I'd like to welcome you to today's program, Economic Outlook, Keeping the Global Recovery on Track, which is sponsored by the OECD iLibrary. Today's discussion is one in a series of sponsored webinars from Choice and ACRL that addresses new ideas and developments of interest to the academic library community. Before we get started, I'd like to point out just a few features of our webinar software. All the attendees who join the presentation are automatically muted and your cameras are off, so don't worry about generating noise or feedback. We've got that taken care of. In the main area of the screen, you can follow along with the presentation materials. We're using the Q&A feature today. Please use it to ask questions of our presenters. We'll answer as many questions as we have time for at the end of the presentation, so please do type your questions into the Q&A module as they occur to you. We plan to have plenty of time for questions. Also note that there is closed captioning available for today's session. To toggle the automated captions on or off, please use the CC button on the bottom right corner of your screen. Also note that we're recording today's program and everyone who registered should receive a follow-up email with a link to the archive version. And with that, we are ready to get started. So I'll pass things over to Miguel Gorman, the Senior Manager for Public Affairs at the OECD Washington Center.
Thank you, Sabrina, and thank you to Choice and ACRL for hosting us this morning. On behalf of the OECD Center here in Washington, DC, and our OECD iLibrary team, I'd like to give a warm welcome to our attendees from all around the world, and thank you for joining today's briefing on the latest OECD Economic Outlook, which was just published yesterday. If this is your first time joining our OECD iLibrary Expert Series, we're particularly happy to have you here. I'm also delighted to welcome back our speakers from the US desk at the OECD Economics Department, Patrick Lenain and Ben Westmore. And by the way, if you haven't already seen the Outlook, you can get it at the following link, oe.cd/economic outlook. And that's all lowercase. Now, I need to say a quick word about what we do here at the Washington Center. We are the OECD's liaison office to the United States and Canada, and we act as a resource for lawmakers, government officials, and the wider policy and academic community. And one of the important resources that we provide to that wider community is the OECD iLibrary. And that houses the latest shared economic knowledge, data, and best practices across policy areas, ranging from agriculture to trade and everything in between. The iLibrary is, of course, a nonprofit program made possible by the support of over 2,500 research institutions, who in turn have about 7 million end users. And if you'd like to learn more about a subscription to the OECD iLibrary for your institution, please reach out to Ian Williamson, whose contact details will be in the email that you'll get after the webinar, along with a copy of the slides from today's presentation. I'll soon hand this over to Patrick and Ben, but the last thing I have to mention before we do, I have to share the news that the OECD iLibrary is a recipient of the Choice Outstanding Academic Title Award this year for overall excellence in presentation and scholarship and importance in building library collections. We are thankful and proud. And without further ado, I'm going to hand things over to Patrick Lenain.
Thank you very much, Miguel, and thank you for the invitation. Once again, it's a great pleasure to be here today to present the new OECD Economic Outlook, which was just published today, as you said. I will go through a series of slides, present our economic projections, and discuss some of the challenges that we see in the economic situation today. I will mostly talk about the global situation for about 10-15 minutes, and then I pass the floor to my colleague Ben Westmore, who will talk specifically about the situation in the United States and our economic projection for the US economy. Just a brief recap, the Economic Outlook is published twice a year, in June and December. This is for the full set of projections. In the meantime, we also publish interim projection in March and September. So in other words, there are 4 sets of projection and 2 books published every year. We are currently covering all OECD countries, but more than OECD countries, also non-members. So altogether, we're covering 50 countries with detailed projections provided in the book and online, as well as country notes describing the projection. We are covering the world GDP, we are covering world trade. Our projections are quite detailed. We provide projections for aggregate demand, public finances, inflation, the labor market, and also potential output and the output gap and number of estimates. And all that is done in the accounting methodology called national accounts. We also do a number of alternative scenarios with a model from the NICR, for instance, what would happen to the world economy if China was to slow down. And there are a number of research notes in the book. This time we have a number of research notes in the form of boxes on inflation, on China, also on the automobile supply chain. So all this material can be found on, obviously, on the Oecd Library. It can be found also on the Oecd website at the address there, or the short link that Miguel provided. Data.oecd.org is, I think, my favorite place to get nice charts on the economic outlook. And for more detailed, I go on stats.oecd.org, where detailed Excel spreadsheet can be downloaded. There's also a blog on the oecdscope.blog. Let me go to the global messages pretty quickly. There's no major change from our projection 3 months ago in terms of GDP growth. So we still see a relatively fast and strong recovery right now, which will be slowing down a little bit in the next 2 years. The main difference, of course, is now we project higher inflation than we did 3 months ago. Still a number of risks in the outlook that I've talked about. Key message as 3 months, 6 months, 12 months ago, is priority is to get everybody vaccinated as quickly as possible. The number of labor shortages, Ben will detail that for the US. The supply disruption have contributed to slow growth and boost inflation. I'll say a word about that. And finally, I'll say a few words about the tricky decisions that central banks have to make in the current situation, and also the difficult challenges that fiscal policymakers are facing currently. Now, as we speak, there is a new wave of COVID-19, and this is the Delta variant, not Omicron. So there's a new wave going on. Some countries, mostly in Europe, and inside Europe, mostly in Germany and Denmark and Northern Europe. So as you can see on the chart, the number of cases is actually reaching higher level than in previous waves. Countries like Austria, Denmark are seeing very high number of cases. But we've learned a lot on how to live with the virus. It's true that there are more cases, but actually the number of lives lost is not surging as the number of cases. Just to remind you, a case is a positive result to a COVID-19 test. So people can test positive, but not have any major symptom. So there are more cases, but we know better thanks to better healthcare, better science, better practices to manage these cases. So hospitals are not as congested as they were during the first wave. We also learn how to manage the pandemic without widespread lockdowns. And the lockdowns are very costly in terms of output and jobs. So we are able to avoid that. A recent trend has been to introduce specific restrictions for the unvaccinated people. For example, they have to show a negative test when they go to a restaurant, when they take the plane, or when they go on the train. There are even specific stay-at-home orders for the unvaccinated in Austria, and Germany is also talking about it. While the fully vaccinated people, especially people who got a booster shot, are left unrestricted. So what we've learned is that vaccination works. and the vaccine can be adapted to new variants. It's about 54% of the world population that has received at least one dose by now. The numbers are really staggering. There are about 33 million doses injected every day. The production of vaccine is incredible. It's 1.5 billion doses produced every month around the world. The full supply chain, logistic, voluntary tech transfer agreement to developing countries so they can produce the vaccine as well. So there's no bottleneck in the production of vaccine. The problem is more the distribution and the reluctance for some group of people to be vaccinated. So what you see on the chart there is that the vaccination rates are now pretty high in rich countries and middle-income countries, but poor countries are lagging behind in terms of vaccination. And that's also true within Europe, where countries like Bulgaria, Romania, the Czech Republic still have very low vaccination rates. Look at the vaccination rate in Bulgaria is only 30%. So the lesson there is that there's a need to really speed up vaccination. And as we say in the past, the pandemic will not stop until all countries are vaccinated. Rich countries can help the poor countries achieve that. The OECD countries have already spent $3 trillion in support measures during the pandemic. It will take only $50 billion to finish vaccinating the whole world. So the cost is not tremendous. Vaccination is especially low in Africa. So you see the share of people who have received at least one dose or are fully vaccinated. China has done a tremendous progress in vaccinating this population. But at the other end of the spectrum, in Nigeria, Cote d'Ivoire, South Africa, obviously, and the whole of Africa, vaccination rates are still very low. In Africa, only 7% of the population is fully vaccinated. And the fact that Omicron has been identified for the first time in South Africa is a sign that pockets of low vaccination end up as fertile ground for a new variant of the virus. But in general, thanks to better health management, vaccine, masking, social distancing, countries have been able to reopen. Economic activity is no longer restricted as it was before. Demand has been strongly supported by fiscal and monetary policy. Confidence has been largely restored. So world GDP has accelerated, and we expect that in the fourth quarter of this year, it will peak at around 6% growth. Growth will still be strong next year, and then we project that GDP growth in the world will slow down to a sustainable pace, similar to the pace that was prevailing before the crisis. Now, the recovery is not the same everywhere. The US really prioritized output activity. So businesses were protected. There were less restriction than in Europe. So activity has already returned to the pre-crisis level in the middle of this year. In Europe, the priority was to protect jobs with job keeper schemes and short-term working schemes. So the labor market is doing better in Europe than in the United States. Overall, after a very strong rebound of 5.6% this year, we forecast world GDP growth to remain at a brisk pace of 4.5% next year, and to moderate to 3.2% in 23. In other words, we project a return to some kind of normality in terms of growth rate. Obviously, there are many risks to this projection, and not only Omicron. We are concerned about policy mistakes in terms of healthcare, supply chain management, and inflation. So we are optimistic, but we are also worried at the same time. And our assessment is that countries are different. It's different health situation, different labor market trends, different level of inflation, different level of indebtedness. So reflecting lags in vaccination, emerging markets are no longer catching up with OECD countries as they were before the pandemic. And that will create problems for fighting poverty in these countries and for reaching higher living standards in these countries. One concern is emerging markets, which were catching up rapidly before the pandemic and will not continue to do so in our projections, such as Brazil, Mexico, South Africa, unless they manage to control the outbreak rapidly. The recovery is driven by strong demand, especially demand for goods rather than services, and thus creating bottlenecks in several industries. While demand is strong, supply has been disrupted. The disruption in logistics, for instance, ships cannot deliver their goods if there are cases of COVID. Also, investment has been weaker during the pandemic. This is very clear in the energy market. The strong demand for oil and gas, but the supply on oil and gas has been disrupted. As you see on the right side of the chart, the level of gas storage in Europe are actually very low. That's a concern because if we had a long and cold winter, natural gas prices would keep on rising. There might even be outages of natural gas in Europe, which is an important source of energy. The supply of electronics has also been disrupted. At the time when there is strong demand for computer chips and electronic chips in general, demand for chips is strong, but supply has been disrupted by plant closure or logistic restrictions. You see on the left part of the chart that the delivery of time of chips has almost doubled from 13 weeks to 22 weeks for delivering chips. The automobile industry has been very much impacted by this disruption in delivery of chips. The car industry is 3% of GDP. It's actually quite important in Germany and Mexico, as you see there. And we estimate that the disruption in the car industry will reduce GDP by almost 2% this year in Germany. So that's very significant. Now, with supply disrupted and very strong demand, it's not surprising that inflation has increased. So what you see on this chart is a different OECD projection for inflation. So it shows that we underestimated the rise of inflation. This orange line here is our projection of December 2020. We did not expect a rise of inflation. Then the May 21 projection, also we thought inflation would slow down. Last September, 3 months ago, same thing, we expect inflation to slow down. And we still expect inflation to slow down. To some extent, some of the supply disruption will ease in the future, assuming that the pandemic comes under control. But there are risks there. And Omicron, if it turns out to be a contagious and lethal virus, and we don't know that yet. There's a lot about this new virus that we don't know, and we have to wait a little bit for scientists to tell us more about Omicron. But if Omicron is a lethal virus, that would lead to further disruption in supply, and the risk that inflation could remain higher than we forecast currently. So inflation is not the same everywhere. Certainly, inflation is quite high in the United States, and then we'll talk about that in a minute. Inflation is also a bit higher in some European countries, but there's not high inflation everywhere. In France, inflation is going to run about 2.5%, so much less than what you see in the United States currently. So there are some countries where inflation has been partly pushed up by the restriction in the market. Now, with elevated inflation and the downside risk from the pandemic, including the Omicron that we don't know about, policymakers need to be very cautious, including the central bank. Slightly tighter monetary policy is needed to address high inflation. but this must be done cautiously. And there is no one-size-fits-all. It depends on countries. The Federal Reserve has already started to act and will continue, but it doesn't imply that all countries should do the same. So far, financial markets do not appear to be very worried about the outlook, or they don't appear to expect a quick tightening of monetary policy. There's no major repricing movement going on in the financial market. So on the chart, the left panel shows the rise of equity prices since May 21. Obviously, equity markets have done very well. There was a little bit of retreat when Omicron was first detected in South Africa, but not a major retreat. So the stock market are quite optimistic about the outlook. The panel in the middle is about interest rate. So what you see there is long-term interest rate, which have increased a little bit in some countries, but Brazil, Turkey, Russia, South Africa, Mexico, but in rich OECD countries, long-term interest rates have not increased markedly. And that means that the market are not expecting central bank to lift off in a significant way in the future. And finally, on the right-hand side, you see currencies of a number of emerging markets. So you probably remember that in past crises, certainly after the financial crisis, when markets were expecting a major tightening of monetary policy, the currencies of this emerging market was depreciating sharply. There was a flight to safety, a return to rich countries because the return on investment in fixed rate market was increasing. This is not happening currently. The market are not expecting that there will be a need to go back to safety in rich countries. Nonetheless, central banks face a tricky balancing act. If they wait too long to tighten, inflation could become more entrenched with a wage price spiral. But if they tighten too soon, they will disrupt the ongoing recovery. And they will create difficulties for borrowers who have accumulated a lot of debt during the crisis. One sector that has accumulated a lot of debt is the public sector. So it's a tricky balancing act also for fiscal policymakers. Fiscal support has been sizable. It's been very important to support the economy during the lockdown. Fiscal support has helped to avoid many bankruptcies. It has helped to avoid mass unemployment. But public debt has increased a lot in all countries, and we project that it will keep on increasing next year and in 2023. Removing fiscal support too soon would undermine the recovery, especially with the downside risk that we face, including Omicron. So fiscal support should remain in place, but it should be used very well, very effectively by focusing on programs that will be important for growth in the future, the so-called building back better. So in other words, good debt rather than bad debt. It means more support to healthcare, be better prepared for future pandemics, more support to childcare so that people can go back to work and leave their children in high quality and affordable childcare. More support to skills, because the post-pandemic jobs will not be the same as the pre-pandemic jobs. More support to digitalization, especially for SMEs that will need to be digitalized to thrive in the future. And more support to the kind of infrastructure that will help to fight climate change. So I'll stop here and pass the floor to Ben, who will dive into more details on the US outlook. Thank you.
Thanks very much, Patrick, and thanks very much to all of you for joining us. As Patrick said, I'm going to delve a little bit more into the US economic outlook. I'll talk about developments, detail our projections, and then also just highlight the risks that we see to the forecast at the moment that are extensive. So the first thing to note in terms of recent developments, private consumption activity has really recovered strongly. So notwithstanding a bit of a slowdown in the third quarter, you can see here that private consumption, the level of private consumption has now returned back around the level where it would have been absent a global pandemic, which is quite an extraordinary feat. The story is slightly different with real GDP. That in terms of the level is still about 2.75% where it would have been without the pandemic if we follow the pre-pandemic trend. And the difference between these reflects the fact that some of the consumption activity has been serviced through imports from abroad, which don't add to domestic production, and also have been serviced through business inventories being run down, which also doesn't add to domestic production in the current period, but will have an impact going forward as businesses rebuild their stocks. So that's just highlighted here quite simply with a chart showing quarterly contributions to GDP growth. And you can see net exports, which is the yellow bar here, has subtracted from GDP growth, net exports being exports minus imports. And so those very strong imports has led to that subtraction. And then also in the first half of this year, you can see that inventories have subtracted from growth. So that's kind of the national accounts, and that's up until the end of the third quarter, up until September. But, we know at the moment it's really a fast evolving economic situation, and it has been throughout the pandemic, and that's led economists to more and more utilize these abundant sources of new data that are more timely, and also, in some cases can give a bit more granularity around recent developments. Our go at this is the OECD weekly tracker of GDP growth. That's shown here. It basically uses machine learning techniques and Google Trends data to give some sort of indicator of GDP growth and tries to measure against actual GDP on a weekly basis. So this chart is updated until about mid-November, and it highlights that there was a bit of a slowdown through the third quarter, but then that in recent months there's been a pickup in economic activity. If we look at some of the high frequency data on consumption activity, we can also see different trends with regard to consumption categories over the pandemic, and also with regard to different cohorts of households. So on the left-hand side, we can see that when the pandemic hit, there was a decline in consumer spending across goods classes, but it was particularly the case for in-person services, not surprising given the nature of the pandemic. Then the rebound in durable goods in particular was particularly rapid. So you can see there by June 2020, the level of consumption of durable goods in the US economy was back well above where it was in January 2020. It rebounded very rapidly, and that's unsurprising given the lockdowns and the fiscal stimulus at the same time that was focused on the household sector enabled this sort of spending. The recovery in the services sector has been much more gradual, but you can see there that even in the last 6 months, that spending on both remote services and in-person services are now somewhere between 15 and 20% above where they were in January 2020. So the kind of recovery in consumption is now broadened out a little bit. If we look at different cohorts of households and we kind of cut the data by the point in the income distribution of different households, you can see here on the left-hand side that income quartile number 1, which is the lowest income households, have actually seen very strong growth in consumption spending, especially strong growth in consumption spending on services compared to Jan 2020. And so it really has been a broadly based consumption recovery across different income quartiles of the distribution. As Patrick kind of touched upon, so the strong demand for consumer goods, especially durable goods, has put pressure on supply chains, combined with some of the supply constraints in origin markets as a result of outbreaks and as a result of social distancing have caused some of these shortages in supply. But you can see here on the left-hand side that it's very much an advanced economy story. In the emerging economies, the delivery times for manufacturing goods has barely increased over the past few months and is only slightly above where it was before the pandemic hit. On the right-hand side, we can see that it's a similar story and a similar pattern across the Euro area, across the United Kingdom and in the United States. But if we focus on that green line on the United States, we can see that these kind of supply pressures are much more pronounced now than they were in the early parts of the pandemic, where there was some sort of discontinuity in these supply chains in these major markets. Patrick touched upon the fact that in the US, there has been a bit of a disconnect between what's happened on the activity side with GDP growth and the recovery and what's happened in the labour market. Employment rates have gradually been picking up in the US, but they're still about, when we look at the employment to population ratio, it's still about 2% below where it was pre-pandemic. If we look across the cohorts of workers and we split out males and females in the prime age versus older workers, it's relatively broadly based in terms of the recovery in the employment to population ratio, but the fact that it still remains lower than it was. And it's interesting that this kind of situation of an incomplete recovery in the labour market is happening at the same time as the labour shortages are becoming more pronounced. So the difference between the job opening rate, which is the blue line here, and the hiring rate, which is the orange line, can be interpreted as the extent of labour shortages. And we can see here that it's at the highest levels than it's been since, over the last decade. This partly has to do with what they're calling the Great Resignation, and you can see there the green line with the quit rate increasing as people leave their jobs. But it's also reflective of people having left the labour force throughout the pandemic and having not rejoined. So if we think about this labour force participation rate and how it's been impacted, it's not uniform across groups. We can see that some of the younger age groups, so both men and women in the 16 to 24-year-old bracket, have seen their labour force participation rates, which were very hard hit at the start of the pandemic, basically recover to those pre-pandemic levels. But that's not the case across all of these cohorts. When we look at people in the 35 to 44 age group, both men and women, their labour force participation rates remain impaired. The fact that these groups most often are the ones that have children in the kind of younger age groups, which have been impacted most by closures of schools, closures of early childhood centres, and maybe combined with some of the fiscal stimulus has allowed some of these people to move out of the labour market is one explaining factor. But the other big group to focus on is the older age workers. So, and in terms of aggregate, the impact on the aggregate labour force participation rate, it's these workers that are having the biggest impact. So the decline in the labour force participation rate of these workers, about 2/3 is as a result of retirements, both early retirements and just natural retirements as the population ages. The other remaining third is a whole range of other factors. Some of it may be to do with concern about contracting the virus at work, given the increased susceptibility of this group to the virus. When we think about going forward, what the prospects are for the return of the labour force participation for this group, it's quite, when we look at history, it can be quite sticky trying to move people back out of retirement into the labour force, and also just the ageing population is going to result in the labour force participation rate of this group being lower than it previously was. So we would say that absent new policy measures, which incentivises labour force participation or assists in labour force participation of this cohort, then we're likely to see a structurally lower labour force participation rate, so lower labour supply from this group going forward. So these labour shortages have resulted in some acceleration in wages. Aggregate wage growth on the left-hand side here is now going at the fastest pace since prior to the financial crisis. Across sectors, there are a number of sectors in which this is occurring, but it's not uniform. We can see here leisure and hospitality, transportation and warehousing being two in particular that are seeing particularly strong wage growth. And part of that is being reflected in prices, and that's part of the reason for the increase in inflation in the US. Inflation has spiked. I'm not telling any of you anything that you don't know. Part of the increase in headline inflation, which is the blue line on the left-hand side, reflects energy prices and motor vehicle prices that may or are likely to come down in the medium term. But when we look at the red line there, which basically cuts out the volatile items in any given month, we can see here that even those less volatile items of the inflation basket are starting to rise in terms of their prices. And the right-hand side figure here shows that at the start, while it was durable and non-durable goods that saw strong price growth, It then, over 2021, has broadened out into the services sector as well. This has resulted and something that is worrying for central banks and for us in inflation expectations drifting higher. You know, when we met 3 months ago, 6 months ago, this was very much a story of short-term inflation expectations having drifted higher, but now we're seeing more longer-term inflation expectations. This is 5-year ahead inflation expectations rising for both households, and so that's taken from household surveys, and those taken from financial market indicators. So if we think about our projections, you know, there's obviously a lot of uncertainty at the moment regarding the pandemic and Omicron, but we expect that over the coming 3 to 6 months, the recovery to continue. And, you know, if the gains with regard to the public health situation can be maintained in the US for activity to continue to recover. And so, you know, we have a downward revision to our forecast compared to where we were at the last economic outlook, but a lot of that is a result of history and the weaker Q2 and Q3 numbers than we were anticipating. We're now expecting, when we're thinking about the level, GDP to recover back to where we expected it to be in late May by the end of 2022. So here are our annual forecasts. We have 5.5% growth in 2021, 3.7% in 2022, and then growth down at 2.4% in 2023, which is lower, but still above what we would expect as being the potential output growth of the US economy. On inflation, for the US, we do have an easing of inflationary pressures in our projections, but we expect inflation to settle, like Patrick was saying, at a higher level than it did prior to the pandemic and well above 2%. So we've got a 2.5% in 2023 in year average terms. We think these inflationary pressures will cause the Fed to tighten in 2022. We think that the federal funds rate will be lifted around the middle of the year. We've got in our projections 2 rate hikes in 2022 and then further rate hikes through 2023, taking the Fed funds rate to the 1.5% to 1.75% range by the end of 2023. You know, it's at the moment, doing economic projections is particularly fraught given the uncertainty that exists. So, you know, risks to the macroeconomic projections are significant. We have, on the upside, the potential that the elevated household saving rate as a result of previous lockdowns and fiscal stimulus could unwind faster than we're anticipating in our projections, and that could spur stronger consumer demand. On the downside, it could be that inflation is more persistent and picks up more strongly than we're currently expecting, and that results in the federal funds rate being increased earlier and by more perhaps than we're factoring in, and that could dent the recovery. And then last but certainly not least, you know, we need to continue to monitor the COVID situation, and it may be that a further resurgence in COVID cases that restricts economic activity either through voluntary or government-imposed lockdowns on particular groups or sectors could impact upon economic activity, and the Omicron variant obviously adds uncertainty to this downside risk. So thanks very much.
Thank you, Patrick and Ben. We're going to go into the Q&A portion of today's event. And as a reminder, please type in your questions in the Q&A box, and we will get to as many as possible today. Patrick and Ben, inflation clearly is a concern right now. And Jay Powell said this week that he thought that the term transitory to describe inflation in the US should be retired. What's your view from Paris? And I don't know which one of you wants to take that.
I mean, I can talk briefly on the US, Patrick. I can't hear you. So yeah, I think that's a wise move. I think, you know, both for the Federal Reserve and for almost everyone else, including ourselves, the inflationary pressures have been less transitory than we were expecting, or more persistent than we were expecting. And some of these components, you know, we were all expecting there to be more price pressures in terms of these components like shelter. Some of the increase in shipping rates start to flow through. Some of these wage pressures start to flow through. But I think some of the supply shortages and some of the kind of frictions around reopening that's resulted in higher prices have been more persistent than we expected. And then, as I outlined in the presentation, I think that the area that we're concerned about, and I think that Chair Powell would be particularly concerned about, is the fact that some of these persistent price pressures are translating into inflation expectations at a relatively long horizon. And Patrick highlighted the risk of that turning into a kind of wage price spiral that becomes self-fulfilling and could either result in inflation becoming out of control, or the Fed or the Fed having to tighten much more aggressively, and that impacting upon the recovery.
Well, the only thing I can add to Ben's explanation is that Jay Powell, the chairman of the Federal Reserve, has done a fantastic job. The tightening of, or I should say, a recalibration of monetary policy was going to happen in any case. But Jay Powell has managed to speed it up a little bit without disrupting the financial market with very careful communication. So President Biden has decided to reappoint Jay Powell, and based on the fantastic job he's done so far, it looks like a very good decision.
Great, thank you both. I think that's a nice segue to another important question, and it's a common theme here in the Q&A, and that is concerning supply chain disruptions. And we have a couple of questions on supply chains that I'm going to try and see if we can take together. The first, Adam is asking what interventions, what policy interventions you might recommend to address supply chain disruptions. And Karen is making an observation that durable goods supply chain problems don't seem to be as pronounced in emerging markets, and why that might be.
I can start to say a few things. And again, I think vaccination, is probably the most important policy intervention to solve many problems, including disruption in supply chain. Think of a ship not able to offload its containers because there's just one positive case of COVID on the ship, and then they are in quarantine. So the faster we vaccinate people, the easier it would be, and obviously Omicron is threatened to disrupt supply chain once again. So I think that's an issue there. So as Ben said, I think I really got surprised by strong demand for goods rather than services. So supply chain have to reorganize themselves. I guess people went on Amazon and started to order goods and also cars. So I think everybody got caught by surprise, including the automobile industry, which was not ordering enough electronic chips. So there's a backlog of order there. And finally, labor shortages. Think of the lack of truck drivers. So how do you operate supply chain, without enough truck drivers? Now, I think the historical experience that, when, for instance, after an earthquake or natural disasters, that supply chain get disrupted temporarily, eventually things go back to normal. There are already signs that, container shipment costs are declining very fast now. But maybe Ben has something to add on that.
Not much. I think you basically touched upon it, Patrick, but I think in terms of, the impact and how long it's likely to take to unwind, and Patrick talked about truck drivers, there is an element here that's international. It's about origin markets and what's happening at the factories, but it's also about what's happening in domestic markets to move things along the supply chain. And in terms of getting, more truck drivers into work, it requires, both, developments with the virus, but also in some cases, labour markets to recalibrate, and some of the increases in wages that we're seeing in these sectors are likely to incentivise more labour supply. and as that kind of process evolves, then it increases output and increases the extent to which supply can be freed up and moved to the final consumer.
Great. And Patrick, you touched upon this link between vaccination rates and supply chain issues. We actually have a behavioral economics question from Tatiana, who's asking if there's any evidence on policies which can help increase vaccination rates. I'm not sure if you have observed that in any of your research, and specifically she's asking whether financial incentives or education campaigns have been observed to work better. Don't know if either of you have thoughts on that.
Well, I think, all of the above, anything that can help to vaccinate people. I think the green pass we have in Europe that gives people freedom when they are fully vaccinated, I think very clearly encouraged a higher vaccination rate. So, in my own country, France, when the president goes on television and announces new restrictions for the unvaccinated, in the hour that follows, there's a surge of appointments to get vaccinated. So I think, giving more freedom when you are vaccinated. I know some countries are giving incentive, like a bit of money or something to eat or to drink. We don't do that in France. I'm not familiar with that. I don't know if, Ben, you're aware of that. But again, anything that can reduce reluctance would be good to take, maybe.
Great. Rocco's asking about the relatively high levels of deficits and debt among many OECD members, and he's wanting to know how that could affect the global economy in the next year or so. And related to that, George is asking about how we might explain the public debt declining in Ireland and Sweden, unlike in other countries. So Rocco was asking about the high levels of deficits and debt and how that might affect the global economy, and George about public debt declining in Ireland and Sweden.
Yeah, maybe I can say a word on public debt, and also Ben can comment on the US situation. We live in a world of extremely low interest rates. So money is basically free. In Europe, we have seen negative interest rates set by the European Central Bank, and even negative interest rate for government borrowing on the financial market. So the issue is not only the level of debt, but it's the cost of debt. So the debt servicing burden depends on the level of interest rate. And it's quite striking that although debt has increased, debt servicing costs have declined, because we're borrowing so cheaply. Now, that's not an excuse to do anything. And as our chief economist said yesterday, we need to make sure that if we keep on borrowing, this is good debt, and that we invest in the things that will build back better and improve the environment for stronger, sustainable, and green growth in the future.
So just on the US, I think it's a similar story. We support overall, the recent package, the infrastructure package, and also a lot of the initiatives that are currently being discussed with regard to the Build Back Better agenda. But it is true that in the future there are fiscal pressures. We're looking at the US debt to GDP ratio being over 200%. It's in the future. An aging population is going to compound those impacts. We know health spending in the US is particularly high in terms of public health spending. So in terms of the medium term and longer term plan, there does have to be a kind of think about the fiscal framework and about where there can be improvements made with regard to spending efficiency and perhaps tax reform to ensure that debt's on a sustainable path. As Patrick says, in the short term, these debt servicing costs seem manageable, but we need to ensure as well that a shock to interest rates doesn't have too adverse an impact, and don't disregard the fact that that can happen in the relatively short term, especially with some of these inflation outcomes. I think the last one, I don't work on Ireland or Sweden, but with some of these European countries, there can be some kind of idiosyncrasies. Miguel, you will know them well for Ireland. And in the Ireland specific case, a lot of it has to do with the denominator, with GDP growth being inflated as a result of the activities of multinationals that can, and so that's in terms of the historic impact that's causing that 2019 to 23 average to be lower than it was previously. But it's I would consider it a flawed metric for that specific metric.
Yeah, and just to add on that, and as our chief economist said yesterday, there's no one size fit all, and key message is that there are huge differences across countries, in many respects. So fiscal policy is one. Some countries have been able to generate a pretty strong recovery without generating large deficit. So the economic outlook, which was released yesterday, it's a big book. I think there are 225 pages, and that includes what we call country notes for 50 countries. So the country note has, 2 or 3 pages of commentary, a couple of graphs, and a table. I was just checking for Sweden and Ireland. We show the government deficit there. And Sweden and Ireland had run pretty small deficit, so that helped to contain public debt. And as Ben said, in case of Ireland, the GDP numbers are very hard to follow because of the operation of multinationals. But again, not the same everywhere. So, very, very important differences across countries.
Great, thank you. We have a couple of labor market questions, and Dimitri is asking about, the so-called Great Resignation, which, everyone has been talking about here in the US, and he's wondering if the risk is overblown in the media. Ben, you touched upon the labor force participation charts in the recovery in your presentation. Do you see evidence of this Great Resignation?
Yeah, thanks, Miguel. So, we do. We saw that in the quit rate chart that we showed, this rise in the quit rate. It has been a rise, but it's not. I wouldn't get too carried away with it. It's been a kind of gradual rise, and it's been most apparent over the past 6 months. Part of that probably has to do with savings that people have accumulated as a result of lockdowns, and also savings that people have accumulated because of the fiscal stimulus focused on the household sector. When we think about that fiscal stimulus and the kind of fiscal impulse, that is really, a lot of these measures, most of these measures were temporary. When you think about supplementary unemployment benefits or think about stimulus checks, they're now no longer continuing to be paid. And so it's kind of a temporary phenomenon that's going to have an impact on household savings and incomes in the short term, but kind of in the medium to longer term, that'll wane. And so some of that kind of comfort that people have from these measures will be reduced and may need them to move back into the labour market. In a lot of ways, there's a potential for this to have a positive effect, though, on the labour market. If you think that people are quitting jobs that either they don't like very much or they're not particularly good at, and thinking about what they, taking a bit of time to think about what they are good at, or, what sectors of the economy they should move into, or moving locations to parts of the economy where there is growth and where, there is high potential for higher wages, then that's good. We talk about creative destruction in recessions, and this is exactly what we're seeing. People moving out of occupations, businesses moving out of particular industries that are not so successful, and moving into other areas where they see there being high potential for growth. And those sort of dynamics is something that we should encourage. And so I think that, that there is the potential for that to be a positive development and have a positive impact on productivity and aggregate economic growth.
Fantastic. And, you know, one thing that we've seen during the pandemic is this huge slowdown in migration flows all over the world, but we've seen it also in the US, labor migration, international students. Gail is asking if you're seeing the impact on GDP already of the slowdown in migration.
I think Ben, being from Australia, a country that has relied so much on immigration, is well placed to answer the question. But I think part of the labor shortages that we see in the US, also in Europe, and in Australia, I mean, reflects reduced flows of immigration. I think we got used to a labor market benefiting from workers from either temporarily or permanently, and that flows had stopped. And I think the country that has suffered a bit from it is Australia.
Yeah, so I think we often talk about the 3 Ps of economic growth: productivity, participation, and population. This decline in migration is really impacting upon population growth in a number of these economies. For the US, so when we think about labor supply and the impact of that on economic growth, we do that in this kind of potential output growth framework. And so that's caused us to revise down what we think is the potential of the US economy in the next few years by about 0.2 to 0.3% per year because of that weaker population growth. We also know, with migration patterns, there's a certain persistence in terms of the direction and the strength of migration flows. And so not only is this going to have a short-term impact over 2020 and 2021, but this might have a kind of more medium-term impact on migration growth and immigration growth and population growth. So yeah, certainly it's having an impact in the US as it is in lots of other OECD countries, and we've shaded down our potential output growth forecasts as a result.
Fantastic. We have time for a couple more questions, I think. We're coming up against our end time. We had circling back to supply chains here for a sec. Undersecretary of State Jose Fernandez was just in Taiwan to talk about semiconductor production. Thomas is asking if either of you see chip manufacturing move into the US or Europe, and what impact would that have?
Well, I think, I don't think I want to comment on the geopolitics between China and Taiwan in the US, but I mean, more generally, the reshoring, bring back some of our some of the production that was offshored and bring it back to OECD economy is a trend that already started, before the crisis, before the pandemic. I think multinationals and governments realized that we were a little bit vulnerable to this supply chain that are really stretched all around the world. It's not only geopolitics or vaccine, can be also natural disasters. So there was already a little bit of reshoring, for instance, of the automobile supply chain back to Mexico. I think countries have realized that it's not only microchip, can be simple things like aspirin or even toilet paper. There might be a few gaps. I mean, we hope this is not overdone. Our Secretary General yesterday, when he released the economic outlook with our chief economist, he said that the world has hugely benefited from a well-functioning supply chain. This has boosted productivity. This has also helped emerging markets a lot to get out of poverty. So maybe, some very limited reshoring of essential goods might be justified, but, we hope it doesn't go beyond that.
Great. And just a final question to round off the Q&A. Josh is asking whether stimulus checks, the direct payments to individuals that we saw here in the US, if you guys think that will become a more popular tool of public policy in the future. And I know European governments and governments here in this hemisphere took a slightly different approach to this during the pandemic, but keen to know what your view is on that.
So, I mean, I can go first just on the US. I mean, I think that's true. That's a good question. And I think it's true. I mean, if you compare the pandemic experience this time around with the response to the financial crisis, at that time, there were people in the administration arguing for stimulus checks and for them being a key tenet of the fiscal response. But for whatever reason, it didn't end up moving through. Whereas this time, it was really a key plank of the way the government responded. I think that after this episode, I think that there'll be lots of postmortems done as to how effective all these various measures were, and the extent to which there was the kind of some of these payments could have been better targeted. And this is not talking about the US specifically. This is talking about all countries, because better targeting into households that have a higher marginal propensity to consume can result in a stronger economic impact at lower fiscal cost. I think certainly with the pandemic, it was one of those things where a lot of these measures were being put together in a relatively short period of time. And so design, in some cases, was sacrificed at the margin for, speed and for volume. But I think that's certainly something that in the next, coming years that we need to assess. But certainly, I think stimulus checks in the US have had a strong impact. And so I wouldn't be surprised if they're more liberally used, at least compared to that financial crisis episode going forward to manage downturns.
Yes, and they were used in the past, for old timers like me. I remember stimulus check, being used, maybe smaller amounts, but after 9/11, also after the financial crisis. So putting a check in the mail, something that make a lot of people happy. As Ben said, maybe this is not the most, maybe politically palatable, but economically, not the most effective, because you end up sending check to rich people who don't, necessarily need it to pay the bills, right? So, I live in France. I wish I would get a check. I don't, because the check are really limited to those people who really need the money, to pay the bills. So the US is quite different from other countries in this kind of intervention.
Patrick and Ben, a huge thanks to both of you for your presentations today and for sharing your insights. I'm afraid that's all we have time for. Sabrina, I will hand it back to you.
Thank you. This is Sabrina from Choice and ACRL. Thank you so much to Ben, Patrick, and Miguel for taking the time to present for us today. And thanks to our attendees for your questions and comments. I'd like to remind our viewers that we did record today's program, so be on the lookout for a follow-up email from the Oecdi Library and Choice ACRL for a link to the video and the economic outlook. Also, if you have a few minutes after the presentation to fill out a brief survey, we would really appreciate it. Your responses help improve our presentations. Thanks again to all of you out there for joining us today. We hope you learned a little bit from the session, and we hope to see you again in the near future on another webinar.
Thank you, Sabrina.
Thank you.